Howdy, guys. Welcome back to the Land Talk Podcast. We are on episode 17 today. We're going to kind of cover something that a lot of folks run into, which is getting a loan. So similar to episode 16 before, we've still got Jack Proctor here from Ag Trust, and we're going to kind of run you through kind of the normal process of things and kind of some pitfalls to watch out for as you're working through getting a loan on a property. So, Jack, what is, in your opinion, the first thing folks need to do if they think they want to buy a property? What's step one?
Right. So as the pursuit of a property comes, I think it's important to reach out to a lending institution and see just how much can you afford. And so that pre-approval process with myself and with Ag Trust in general is pretty simple. We're going to ask you 6 or 8 questions. Do you have the needed down money, which can be 15 to 20% in
Right.
cases? What does your credit score look like? Does it meet our credit score minimum requirement, which is a 680? Where is the property and where are you located? What's your combined annual income and what are your other debts? And once we get the answers to that question, we're able to tell you, on a rough amount, like, hey, we can lend you this much. If you want to go out and find a realtor, if you want to pick up the phone and call John Dean, he can help you find a property in your budget.
Right. So that's a pre-approval, which is obviously kind of the very first step. I know as a broker and as agents, like, we really love pre-approvals because then we know that we can go spend time with you looking for properties and, you have the means to back that up. So, over the years we've had, which I like to take people's word for it, we've had a lot of folks that want to look at a property and we spend a lot of time doing these things, and then lo and behold, they can't qualify for whatever amount they needed. So, which is heartbreaking for us, heartbreaking for them. It's just not good all around. But so we love pre-approvals. That's the best first step. What's the difference between a pre-approval and a pre-qualification? I know those are a little different. What's the difference between those two different things?
So when I look at the difference between those two things, a pre-qualification has a specific property in mind, whereas a pre-approval doesn't have that property in mind. So once you get pre-approved, say up to, just for the sake of this conversation, $400,000. Now you've got, what your budget is, that you can afford up to a $400,000 debt with your income, and you've got the needed down money for that. And so you can pick up the phone and call John Dean, and he'll take you and show you a property in that price range. Well, once you've got that specific property, most brokers and agents that I know, before sitting down to write a contract, both selling and buying agents want to know that they have been pre-qualified for this piece of property. Because when we start to look at what we can lend on, there is some properties that we can't lend on. Easiest example would be something under 5 acres.
Right.
For the most part, we're 5 acres and up.
Sure.
So you find a 2-acre lot that's in your budget, and your broker and the selling agent write up this contract. Well, you haven't been pre-qualified for that because we can't finance a 2-acre property.
Sure. And I know the big things of getting a pre-approval or a pre-qualification letter is that most of the time when we submit an offer, we would love to have that with us. And that's just telling, if we're working with a buyer and we're giving this offer to a seller, that tells the seller, hey, we're serious. We're not pulling your leg. We're not wasting your time. We've already done enough due diligence to know that, hey, I can afford this. And, I have the means to back up what I'm writing on paper. So I think that's all a good thing. Obviously, after you get pre-approved, that's when you come to me or one of my agents. We're going to look for properties. We're going to find the right one. We're going to get it under contract. Once it's under contract, typically they're going to come back to you, right? We're going to send you a copy of that contract, send it to title, but they're going to come back to you kind of what's the next step. Typically they fill out like a formal application at that point, right?
Right. Yes, sir. So at that point, we would send a loan application that could be filled out with financial info, personal info, along with an environmental questionnaire.
Mm-hmm.
And that environmental questionnaire is essentially asking, is there any hazardous materials on the property? A lot of times the easiest way to explain it is, hey, does the property glow red at night? Mm-hmm. And from there, once we get that application submitted, I have two loan admins in Georgetown that work under me, and they're great. I couldn't do my job without them. They typically send those applications out once the the new customer or new buyer gives me a call and says, hey, we found this property, it's under contract. I get the contract, we get that application filled out, and that kind of starts the loan process. And so from there, we get all the information entered into our system. I look through it and send it to our credit underwriting team, which everything that we do is in-house for the most part. Some larger loans, there might be what we call some participations with other associations, but our everyday loans and 90% of our stuff, I would assume we don't do that with. Everything's in-house from credit to appraisal. So we would get that to our credit underwriter. Depending on the size of the loan, for the most part, if the loan's under $1 million, we can get an approval notice within 5 to 10 days. Get it through our underwriting department. And another thing that we do immediately when a loan application has been entered is we go ahead and order that appraisal for it. We get it on our appraiser's list. And so once we get through credit underwriting, there's not a whole lot that's needed from the borrower. At that point, we're just waiting on the appraiser to have time to pick up that property. Once the loan's been through credit underwriting, I'll reach out back to the borrower, send them that approval notice, let them know that they've been approved. We're just waiting on the appraisal. And as we get closer to closing is when we'll start to narrow in on a rate lock. So typically around pre-qualification and loan application time is a good time to go over rates, but our rates do change daily.
Sure.
Not a lot, it just sometimes it's up 2 or 3 basis points, sometimes it's down 2 or 3 basis points, but there is some fluctuation between the time that the loan application's been submitted and closing.
Sure.
So when we lock a rate, it's locked for 30 days, meaning if that loan doesn't fund in 30 days and close, then the rate expires. And so a lot of times it's kind of playing with that is, are the rates right? If the rates are rising, then we want to lock that rate as soon as possible. If they're
Sure.
falling, then we want to
hold out.
Right. And so typically, here recently, it's been about a week or so before closing. I'll reach back out to the borrower with the refreshed rate and see which one they want to choose. And then we're just waiting on the appraisal.
Right.
But
And back to the application real quick. So, like as far as like a pre-approval or a pre-qualification, you're not gonna pull credit at that point, correct? So
No.
you're only pulling credit when you get to the application. Is that right?
That's correct. So we understand that a lot of land deals and land negotiations can take over 30 days. There's inspections, whether it's a well inspection or people having to travel just to see that land and negotiation. So we're not going to do a hard credit pull and ding you for pre-qualification and then something happened with the negotiation and getting it under contract. And next thing you know, it's been 45 days. And
Right, and you got to do it again.
then we got to do it again. And
Yeah. As far as that application, so obviously I'm self-employed. I've got to get a lot of when I do an application, I feel like I have to get a lot of stuff for you. What are some good tips? So I think if you're a W-2 employee, it's probably a little easier, right? But for somebody who farms or ranches, they're their own boss, whatever it is, kind of what are some good tips to have on hand? Because I feel like, I kind of keep a running tally of just things in general in my business and in my, financials. I don't know if that's helpful. What are some things that would help the self-employed guy get ready to get all the docs they need to you?
Right, absolutely. And we see that a lot in farm credit. A lot of our borrowers are employed by themselves and maybe they own 2 or 3 different entities.
Sure.
And they've got 4 tax returns that they have to file each year. And so what makes it easier a lot of times for us is bookkeeping. So you've got your taxes, but a lot of times taxes are going to be outdated. And if you're waiting to file, you've got an extension, then what we'll need to work with that, depending on the loan size, the changes in loan size, there's more and less restrictions
Sure.
on what we can and can't get by with. But having an updated bookkeeping, whether that's a profit and loss statement or a balance sheet, I think overall I heard a while back that a good thing to do is to fill out your balance sheet at least once a year. I know that that personally I try to do one on 12/31 of each year, and I have for the last 3 or 4 years. And I think having an updated record system, knowing what you're spending, knowing what you're making, and kind of having that budget and having it ready to go
Sure.
is helpful.
Yeah.
A
And a
lot.
lot of it has to deal with debt. I mean, I think you got to
Mhm.
know, here's my car payment, here's my house payment, here's credit card debt, whatever. So,
Right.
I know tracking debt's always a big thing. So,
Right. Yes, sir. A lot of times if I know that they're pretty serious about the property and they have a lot going on financially, what I like to do is just go ahead and once we pre-qualify them for a property, go ahead and send them a list of what we're going to need. If somebody's going to buy a $2 million property, we're going to need 3 years of tax returns, 3 years of K-1 statements if they're a minority owner in an entity, and 3 years of tax returns if they're a majority owner in that entity. And that can take time, and
Sure.
we're aware of that. So anything that we can do to get ahead of that is appreciated all the way around.
yeah, yeah. And I know for me, I get taught a lesson every time I need a loan that I just need to keep some certain things kind of handy and fresh. And that way I don't have to go back digging through boxes to find who knows what I need from some years ago. But so you kind of mentioned minimum credit scores. You said it was a 680. Is that right?
Yes, sir, that's correct.
Okay, so 680 minimum credit score, and then typically we're seeing 15 to 20% down. And I know every loan's probably going to vary a little bit. There's sometimes 15% works, and maybe there's sometimes 15% doesn't. Right. So give us a spiel there of kind of how different loans can be. I mean, like I said, every one of them's a little unique, right? So.
Right. So, your everyday average property out 15, 20, 30 acres out in Milam County, a 15 to 20% down payment is going to work. We do have different classifications of land to get more technical. We have what we call land in transition, and then we have what we call high dollar land. And as we start to look at that land, it's going to be higher dollar land that may or may not be transitioning out of agriculture, and the loan terms and the rates get stricter. We don't see that a lot. When we look at high dollar land, that's going to have a 25% down payment and a 20-year term.
Right, and that's kind of more of a commercial
Right.
type deal.
Yes.
Yeah.
Same with land in transition is going to be the land that looks like it could transition out of agriculture right on the outside of Austin or a metropolitan area. But for your everyday land that most people are buying, it's going to be 15 to 20% down onto a 20, 25, 30-year term, whatever best fits the borrower.
Right. And so amortization, you just nailed it on. I mean, you can do 10, 15, 20, 30-year notes. And obviously y'all don't do any kind of prepayment penalty, right? So you can pay anything towards the principal anytime.
Right. Yes, sir. So most of our loans are open prepayment. You can pay it off. You can pay it down as much. We have some other options where there could be a prepayment penalty for a year to lower that rate. We call that a 1-year lockout. And with that 1-year lockout, it's a 1.25% prepayment penalty for the first 12 months that the loan is booked. And it typically lowers your rate 15 to 40 basis points. But you can't pay anything extra. You can't do a rate conversion for the first year.
But your typical loan, what's your typical ARM on that? Is it a 5-year? What's your typical?
So, a 3 to 7 year rate term is what's been most popular. And I think it goes back to that rate conversion that we talked about in the previous episode. But I feel, and I think that most of our customers feel that whether it's 3 or 7 or 5 years, it gives them enough time for that interest rate to fluctuate. And they can do a rate conversion and relock that rate, before it expires and potentially lock it for the life of the loan.
For sure. And I guess on adjustable rates, I mean, right now interest rates are kind of trending down for the most part, but there's been times where interest rates go up. So I guess there's always a chance in an adjustable rate loan that you have a 5-year initial term and year 5 ends and you could go up, right? So I know it's good right now because we're trending down, but I know folks that had loans that they go up too. So I guess there's always like two sides of that coin, So
Yes.
Hopefully we're just keep trending down. That'll be better for everybody. We've had a lot of folks doing 1031 exchanges lately, which we're going to have an episode where we get really in depth on those. But basically, if a 1031 is taking funds from another sale and you're deferring the taxes by buying another like kind property, what's kind of a short pitch to folks doing a 1031 as far as maybe they shouldn't do the normal 1031? Maybe they should do like a cash out 1031. Kind of give me a spill there for the 1031 folks.
Right. So there's a couple ways that we can help with the 1031, whether that, if they need some additional funds to purchase that property, their 1031, the sale of their like kind property doesn't quite meet the purchase price of this other property.
Right.
We can come in and finance like that. Another thing that seems to be really helpful for those involved in 1031 transfers is if it's a non-homestead property that they're doing a 1031 transfer to, once that transfer is completed, we can do a cash out and give them up to a certain percentage value of that property, just kind of depending on the property, what they're looking to do with it, what their ag intentions are, but they can get that cash back out of
Right.
their property to use for other areas.
And really, in that scenario, it may save you a lot of capital gains, which capital gains are generally 0, 15, or 20%. Probably most of the time, they're going to be 15 to 20%, right? You may even get a Medicare tax on top. It could be up to close to 24%. So I think that's a cool tool that I wasn't really super familiar with until lately, but you can pull that money out, defer the taxes, and obviously you have to replace it with some debt that's going to take 5, 6, 7% annual interest. But I think it's a cool way to defer taxes and get some cash to go do other projects with. So
Right.
I think that's a really cool thing. So kind of jumping back towards appraisals. So if y'all do appraisals in house, how, and I know you're not an appraiser, but you work with one. Give me the general rundown of how an appraisal works. What is their job? How do they do it? And then I wanted to kind of talk about loan to value, and we can jump into, sometimes properties don't appraise. So kind of give me the spiel on appraisals.
Right. So we do, as mentioned, we have an in-house appraisal team, and my appraiser that I work with primarily has been great. She's been around Ag Trust for a long time. She knows what she's doing. She's been around the area for a long time, which makes it really helpful.
Mm-hmm.
But what she's doing is she's going out and placing a value on this property. She's going to look at the property, look at any improvements on the property, measure those improvements, see, is it a 2,200 square foot house or is it a 3,500 square foot house? And then from there, she's going to pull comparable sales from the area and make sure, if you're in an area where 10 acres has previously been selling for $4,500 an acre, and now this tract is under contract for $13,000 an acre, there's going to be a difference between the two of them, and it's putting a value on that property that others think it's worth based on what is sold recently in that area.
Sure. And obviously appraisals are the lender looking out for their best interest to make sure that if something happens, that the loan they made is a good loan. And obviously we've seen, 20 years ago now that what subprime loans can do and bad appraisals and things like that. So tell me about loan to value. And I know that kind of drives back to your down payment. So give me the rundown of loan to value and kind of how that comes into play.
Of course. So loan to value is what we look at from a collateral standpoint, and that's where this 15 to 20% comes in. So for the sake of this conversation, if a property appraises for $100,000, then and we have a limit of a 85% loan to value, that means that we can only lend up to 85% of the value of that property.
Mm-hmm.
So if it appraised for $100,000, then we can lend up to $85,000. And I think another thing that's important to mention is with our lending, we have to consider not only the sales price but also the appraised value. So we're going to go with the lower of the two. So if the sales price is $100,000, but it came back appraised at $105,000, then we will have to use the sales price of $100,000 when we look at that 85% loan to value.
Right. And if a property, let's say it doesn't appraise, let's say you were shooting for 100 and it came in at 80, you can still only loan 85% of now the $85,000, right? So I think that gets kind of missed a lot of times that if something comes in low, the ratio is still the same, right?
Right.
So So I think that's important there. And like I said, y'all do all the appraisals in house. I think that's super helpful. It's nice to know who's doing the appraisal. Um, so once we get through the appraisal, and we always hope that it appraises out. I know there's some properties where we kind of hold our breath and hope, but in the event that it appraises out, kind of give us the wrap up on finishing out a loan after the appraisal.
Right. So once it appraises, depending on when's closing has been scheduled, when both buyers and sellers agree to closing, we can close up to 48 hours after the appraisal has been completed. So once we get that appraisal back, we're going to send the appraisal to the new buyer, and our doc prep team, so our documentation preparers, are going to start getting all those documents to the title company that's been selected. And the title company and a few of our document preparers are going to go back and forth. They're going to kind of just flesh out the details on the settlement statement and get everything ready for closing, whether that's in 2 days or 4 days, whenever closing is scheduled.
Right. And so at closing, obviously there's going to be a bunch. We know that lenders have a lot of paperwork, and I always joke that the loan officer wrote them up, but I know you didn't. But so you're going to have a lot of papers to sign. Mm-hmm. Obviously, our recommendation is always read everything. It's a little difficult to understand, but you should read them all. That being said, what kind of secures your loan to the property at the end of the day?
Right. So that's going to be the deed of trust, and it's going to tell you what you can't do on the property. A common deed restriction would be pig farming. Mm-hmm. And on those documents that you're going to have to sign, the majority of our documents will be sent via e-sign,
sure.
DocuSign.
Which is a lot easier.
Yes, it tends to save a lot of time at title companies.
Yeah.
And both AgTrust and the majority of the title companies that we work with will get the documents to you ahead of closing so that you can review them and have your questions ready for your title company when you get to closing.
Right, and that deed of trust generally is going to say something to the effect of you have to keep the property in good condition and that sort of stuff. So kind of to your point there. But then also you're going to have a promissory note too, right? So what does a promissory note do for y'all?
So that's saying that we have, securing our rights for the property and the loan on the property.
Yeah, and I think to kind of water it down, it's a borrower promising to pay that back to the lender. So so you'll see those two things at closing. Those are pretty regular on things with loans. What I'm going to go way back, but to sum all this up, if you're getting ready to get a loan, what are some things you should do in advance? And I know we kind of talked about a few of those. And one thing that kind of came to my mind is if you're going to go ahead and get a pre-approval, how long is that pre-approval good for? Like, when can you start the process with you? I guess from the beginning.
Mm-hmm. I don't know if there's ever such thing as too early to start the process. And a lot of times it can be as simple as a 5-minute phone call, like, "Hey Jack, I'm trying to buy some property." And as that conversation progresses, it either ends quickly or it continues. Sure. Like, "Okay, do you have the needed down money? Do you know what your credit scores are? Do you know what your monthly income is and what your monthly debts are? If you're making $5,000 a month and you have $6,000 in debt, then there's going to have to be some cleanup.
Right.
Start paying off those credit cards. I think large credit card bills is what I see disqualify a lot of people from buying property more so than anything else. As far as how long the pre-approval would be good for, I think it depends on what's changing for each customer and borrower. If I pre-qualify you or get you a pre-approval letter, and then you go out and you buy a new Ford truck for $90,000,
or you change jobs or lose jobs,
right? Some
life events, right?
Yes, sir.
So, and the good thing is, like, those pre-approvals once again are not tied to credit, and I know those have like an expiration, right? So, but yeah, I would always suggest reaching out, and typically, like, when I find a property that I want to buy, the first thing I'm going to do is call a lender. I'm going to say, "Hey, this is what I've got going on. Do you think I can swing it? Do you think I can not? Is there a red flag?" And I think it's good to have a relationship. So I would say if you're looking to buy land, it would be good to call lenders sooner than later, even if it's informal, just to get some type of relationship with somewhere you can call when you do get ready. But yeah, I mean, it may take a while to get, and like I said, you may find something that, hey, I need to clean this up. I need to fix my credit. I need to get rid of this debt. I need to pay off this piece of equipment, whatever it is. So I don't think you can start too early. And I know people that have, they call a lender and they it may take them a year to find a piece of property or whatever. So I think sooner is always better, and you don't want to be surprised later, right? So
Right.
that's heartbreaking when you find a property and you fall in love with it, and then you didn't have your ducks in a row the right way. So
Yeah. Yeah, and most land purchases are a big deal, if not the most expensive thing somebody's purchased, then close to the most expensive thing they purchased. So anything you can do to start preparing for that, and a lot of times it's somebody's homestead. It's where they're going to raise their children. It's where they're going to introduce their children to agriculture and responsibilities, what it means to get up and feed animals every morning, what it means to mow the yard. And so anything you can do to get ahead of that, whether that's paying down your credit cards or just reaching out and giving me a quick, 5-minute call. Hey, I'm so and so. I'd like to buy property in a year or 2 years. What's your advice? What do I need to look for in a property? What do I need to look for financially? How do I prepare for this?
And down payment's a big one, right? I mean, 20% can be really hard to do sometimes. Now the good thing about putting 15 or 20% down, y'all don't have any PMI, correct?
Correct.
So even if it's only 15, because usually on a home loan, if you put down anything less than 20, you have PMI. But I know with y'all's, you can put down 15, you still don't have PMI, which is great. There's a few $100s a month you can save. But yeah, I think, land's going to make you put a bigger down payment than a house. You can get into a house for 0 down. You can get in a house for 3.5%. A little easier for obvious reasons. You have to live somewhere. Land's a little bit more of a luxury a lot of times, but I think what I see most of the time is down payment. I think a lot of people call me and they either didn't know or they heard wrong, right? So they either had no idea. I think they're used to, well, I put 3.5% down on my house. Can I put 3.5%? No, you can't. A lot of folks think, well, oh, my down payment's 10%. No, Veterans Land Board can do 5% or 0. But yeah, I think that's the biggest thing that I run into is just kind of not expecting a 15 or 20% down payment, which, like I said, can take a long time to save up. If it's $1 million property, that's $200,000 you have to save up, and it's got to be liquid, and it has to be above and beyond the normal money you need to live every day. So, a lot of big decisions to be made, and I think having a lender that's on your side it makes you feel better at the end of the day. So, anything else as far as getting ready for a loan? I mean, that's.
Yeah, no, I mean, I think that pretty much wraps it up. I'm glad that you mentioned the Veterans Land Board. There are some institutions out there that can do that. There's FSA, and I'm really appreciative for the FSA, and we've had some FSA guarantees on loans, and one thing, we talk about starting early. If you're going to work with the FSA, it needs to start early, because sometimes it's, I'm not an employee of the Farm Service Agency, and I haven't ever had a loan with them personally, but I've worked with some others, that 4 to 6 months to close. And I think that's another thing that really makes me proud to be an employee of Ag Trust. We're not by any means the largest farm credit, even in Texas. But we're big enough to be able to get the deal done for you, and small enough to be able to feel like a community, I feel like.
Yeah, that's a good spot to be. And I've tried to get loans from different places over the years. One of the things that frustrated me was, it would take maybe 30 or 40 days to get approved for a loan, which I think is just too long. So I like that y'all can move some things quickly. And just my experience over the years, I have folks that want to do different types of loans. Maybe it is FSA, maybe it's Veterans Land Board. And a lot of times, I think there's some benefits of going a more conventional route. I like the Veterans Land Board a lot, and I think if that's the option you have, it's a great one. The bad thing is, if you look at kind of the big picture, I think some of those loans are kind of hurt you more in the long run. So I think it's good to explore all loans. If you're a veteran and Veterans Land Board's an option, I would look into that, but I would also look into conventional stuff. And then obviously you got to do which one's best for you. But just because the down payment's lower may not mean that it's better.
Right.
But there's some folks that say, hey, I'm never going to get 20%. I can only do 5%. And then, it is what it is. But I think it's good to look at a couple different options. And who knows? Like I said, I always like working with Farm Credit. But, a really prudent buyer should probably call 2 or 3 lenders and pick the one that's best for them. And like I said, everyone's got something to offer. So I think it's just, kind of a matter of perspective and kind of the whole package. But yeah, I always enjoy working with y'all. Like I said, it's always been a good relationship, and yeah, we get to work together and have fun. So that's a good deal.
Yeah.
So yeah. All right, guys. Well, thanks for listening to Land Talk today. We hope you found something useful there on land loans. Jack, thanks for being with us today, and we'll see you down the road.